Exercise 6-28 is calculate break-even point and contribution margin. So we have Friendly Airways is a small two-passenger plane airline, has asked for your assistance in basic analysis of its operations. Both planes seat 110 passengers each and then fly commuters to Friendly's base airport to major cities in the province metropolis. Each month 40 round-trip flights are made. Below is a recent month's activity in the form of a cost, volume, profit, income statement. So we are given revenue, variable costs, fixed costs to get our operating income. So the first part is calculate the break-even point in dollars and number of fares. So to calculate break-even in dollars, we use the contribution margin ratio divided by revenue. So our contribution margin ratio is contribution margin divided by revenue. So our contribution margin is $27,500. So I'm pulling that from their income statement, contribution margin of $27,500. Their revenue is $50,000. So our contribution margin ratio is 55%. So 55% of all sales is going to the contribution margin, which means 45 is variable cost. To determine our break-even point in dollars, we take fixed costs over the contribution margin ratio. So we were given in the question fixed costs of $22,000. We're finding that on the income statement. We just calculated the contribution margin of 55%. So we take $22,000 divided by 55%. That gives us $40,000. So revenues of $40,000 gives us our break-even point. In terms of having that same calculation in number of fares, we can do the contribution margin of fares as in units to determine our break-even point. So we calculate that, and then we take our fixed cost divided by that. So our contribution margin is again $27,500. The number of fares in the month is given by fares revenue. It says 400 fares in the revenue column, which means the contribution margin per unit sold is $68.75. So that's the margin they get per fare. So to determine the break-even cost in terms of fares, again we take our fixed costs. There's $22,000. We now divide it by $68.75 is the contribution margin we get per fare, which means we need to sell 320 fares to break even. So at 320 fares, it'll cover our variable costs and all of our fixed costs, so our operating income will be zero. So we can do it in terms of dollars. We need to sell $40,000 worth of revenue, or we can say we need to sell 320 fares to break even. So now we know the point we will break even. Part B says, without calculations, determine the contribution margin at break-even point. Well, our contribution margin would have to be our fixed costs because we want our operating income to be zero. So right now our fixed costs are $22,000, so our contribution margin at break-even would be $22,000. Okay, so we don't need to really calculate that. We know that we are looking for our contribution margin to equal our fixed costs, and that's at $22,000. because we know our fixed costs are $22,000. All right, the final scenario says if fares were decreased by 10%, an additional 80 fares could be generated. However, total variable costs would increase by 20%. So we're trying to determine should we adopt this fare decrease. So we would get more fares, but it's more variable costs. So we need to calculate the current fare. So the current fare is the $50,000 divided by 400 fares. So we're right now charging $125 per fare. If we reduce it by 10%, we're going to take 125 times 90%, or our new fare would be we'd only charge $12,050 for each fare. However, our new variable costs will change, so our old variable cost was 22,500 divided by 4,400 fares, and then we're going to multiply by 120%. So our new variable cost is $67.50, which gives us a new contribution margin of 45. So our new fare is $12.50. Our variable costs are $67.50 under the new model, which means our new contribution margin per unit is 45. So now we're just going to do a quick income statement to determine whether this is a good choice or a bad choice for the company. So our revenue now is going to be $112.50 per fare times 480 fares. Currently we have 400 fares. This new model we anticipate to get 80 new fares, so that would be a total of 480 fares. So that would be revenue of $54,000. So as you can see, our revenue is increased. Our variable costs are now $67,550, which will multiply by the 480 fares we expect to sell to get a new contribution margin of $21,600. Our fixed costs are $22,000, which puts us at an operating loss of $400. So in this scenario, decreasing the price to get those 80 fares is not a good option because it actually puts us in a loss. We are not even breaking even on this new. So we would recommend that they do not adopt this fare decrease.